Stock market news is usually full of doom and gloom, salacious revelations of scandals and fraud, horror stories of big bets gone wrong, laments about the fat cats of Wall Street winning at the expense of the little guys. But in January of 2021, the biggest story on Wall Street was a David and Goliath tale of the little guys sticking it to the man. A small group of independent online investors took a struggling company, a known loser and one of the most bet-against stocks on the market, and launched one of the most epic stock climbs in market history. GameStop shares climbed 1,700% in just a few weeks, throwing the market into chaos and even disrupting trading as some of the world's mightiest investment funds lost billions and teetered on the brink of collapse. Why did this group of vigilante investors decide to take on the giants of Wall Street, and how exactly did they do it? Is GameStop really breaking the stock market? The stock market operates on the principles of supply and demand. Take the new PS5, for example. At the moment, demand for the long-awaited new console is sky high, but it's nearly impossible to find a PS5 anywhere. As long as the supply struggles to keep up with the high demand, the price of a PS5 will remain high. Demand for the old PS4s, meanwhile, has basically disappeared overnight, causing the price of the older console to drop dramatically. The stock market works the same way. The more in demand a company's stock is, the higher the price investors will pay per share. Investors are also not powerless against the whims of the market. Investors' buying and selling behavior has a very real impact on market prices by signaling how strong the demand for a particular stock or industry. If the latest hot stock tip sends a tidal wave of people rushing to buy, say, Apple shares, then the price of Apple shares will go up. Conversely, if, as was the case during the 2008 financial crisis, panicked investors rush to sell their shares and pull their money out of the market, then the market will register this drop in demand and prices will fall to match. When it comes to investing, size matters too. Bigger investors will always have more sway over the stock market as a whole because of the huge volume of cash they have to play with. Big players like the major banks, huge pension funds, mutual funds, and especially the exclusive and risk-happy hedge funds have long dominated Wall Street. These hedge funds pool together the money of many individual investors, giving them the ability to use more complex financial instruments to take bigger risks with their huge piles of capital. With this amount of money at play, each transaction made by these supersized funds has an outsized impact on the market as a whole. The 2008 crash, for example, was the result of a few big players taking a huge risk with vast sums of money. When the investment collapsed, it brought down the entire market in the process, and it was the little guys who ultimately paid the price. Everyday investors lost their homes, their pensions, and their life savings, while the banks got billions in government bailouts. Compared to the power these giants have to shape the market, individual investors have historically been considered irrelevant to the stock market. And that's largely been true until now. Recent technological advancements have led to the democratizing of investing and opened up the market to a new generation of small retail investors. With the rise of low-fee online trading platforms like Robinhood, individual investors no longer have to pay an analyst to manage their investments for them. Now, retail investors can DIY their own portfolios while turning to the power of the internet to learn all about investing, to connect with like-minded investors, and in some cases even mobilize a small army of investors to take the fight directly to Wall Street. There's no denying that the rise of the retail investor has played a huge role in this David and Goliath saga. When the saga first began, GameStop was a failing company, struggling as the gaming industry moved increasingly online and gamers no longer looked to bricks-and-mortar stores. GameStop stock was a known loser, and for this reason it had become one of the most bet-against stocks on the market. Major hedge funds like Melvin Capital and Citron Research were just a few of the many who had taken large short positions on the GameStop stock, hoping to cash in on the company's inevitable failure. Successful investing basically comes down to buying low and selling high. Short selling capitalizes on this same principle but with a twist. Instead of buying the shares outright and holding them until the price goes up, short sellers are betting on a stock without actually having to own it. In fact, they're betting that the stock will fail and the price will fall. Short sellers borrow shares now and immediately sell them at a high price, hoping that the price will drop before they actually have to buy the shares to repay the loan. Short selling is a favorite strategy of the big players on Wall Street, especially the exclusive hedge funds that cater to the ultra-rich. Short selling is also an incredibly risky strategy. When it pays off big, but when a short position fails, it fails spectacularly. For those of us without an economics degree, Reddit has our backs here too. A post on Wallstreetbets provided a very colorful analogy that's helpful in understanding short selling. Let's say there's a monkey who hates bananas, so he bets against them, thinking the value of bananas will go down. Seeing this, a gorilla tells all of his gorilla friends to buy up all the bananas they can find, which drives the price of bananas up. Now, Monkey, having bet against bananas, is in a tough spot. He either has to risk losing even more money if the price of bananas continues to climb, or he has to buy the bananas now at their higher price, further driving up the price of bananas in the process. It's a lose-lose situation for Monkey, or in this case, Wall Street. Shorting failing stocks was not a new concept. Major funds had been making risky bets against failing stocks for decades before GameStop became the latest darling of the short-selling crowd. It's not clear why this particular stock attracted the attention of internet investing vigilantes. Perhaps nostalgia for bricks-and-mortar stores, an affinity for video games, or just loyalty to the little guy. But what is clear is that the members of the Wallstreetbets board on Reddit have long held a burning grudge against short sellers, and they were eager for an opportunity to exact their revenge on the Wall Street crooks they blamed for setting up the House of Cards financial system that led to the 2008 global financial collapse. Harnessing the power of the internet, Redditors on Wallstreetbets started encouraging each other to buy up shares of GameStop. To the moon was their rallying cry and their explicit goal. They envisioned a coordinated effort on the part of small investors that would drive GameStop's share price up, and in the process foil the short sellers who had bet big money on the company failing. The actions of this small group of individual investors did indeed cause GameStop's stock price to begin to rise. Some of the early rise was legitimate. GameStop shares did seem to be undervalued, especially as the pandemic boosted video game sales. And in early January, GameStop also announced the appointment of 3 new board members, including Chewy co-founder Ryan Cohen, who would bring the wealth of digital experience to the struggling company. On the day of the announcement, GameStop stock rose 13%, a completely normal reaction to the news. But from that day on, nothing about GameStop's rise would be normal. 2 days later, the stock rose a shocking 57%, then another 27% later that week. The following week saw gains of 10% on 2 separate days, then an astonishing gain of 51%. The next week, the stock kept climbing, growing 18% one day, then 93% the next day, and then more than doubling by the end of the week. By the end of January, GameStop shares had skyrocketed a staggering 1,700% in just a few weeks, and shares that had cost just $4 a year ago were now valued at more than $200. What had happened to account for this astonishing rise? In short, GameStop had become a movement. GameStop was about more than just making money. It was about taking down the man and punishing short sellers. The movement took off and even led to the coining of a new term, meme stock. It attracted a huge amount of media attention thanks to the Trump vacuum, and membership in the Reddit group Wallstreetbets exploded from less than 2 million to more than 6 million members in a matter of days. The movement also gained some famous supporters. Elon Musk, known to hate short selling, tweeted, "Get shorty." Politician Alexandria Ocasio-Cortez praised the movement, saying everyday people were finally able to proactively organize and get back at the folks that have historically had all the marbles on Wall Street and forced one hedge fund into an existential crisis. Famous tech investor Chamath Palihapitiya got into the mix too, investing his own money in GameStop and vowing to donate the profits to charity. He defended the retail investing phenomenon, warning that instead of having idea dinners or quiet whispered conversations amongst hedge funds in the Hamptons, these kids have the courage to do it transparently in a forum. What it proves is this retail investor phenomenon is here to stay. As GameStop's stock price continued to climb, the Wall Street giants who had shorted the stock were starting to sweat. They were in trouble. As the price of the GameStop shares they'd bet against climbed, their losses continued to mount. Funds were forced to hedge their short positions, backed into buying up shares at the current price, which was much higher than the price they'd already sold the borrowed shares for. As the funds joined the fray and started buying up GameStop shares to repay their loans, they helped further drive up the price and compounded their own losses, which quickly climbed into the tens of billions. This, more than anything else, was the ultimate goal of the small group of investors who'd started the movement. One of the Wallstreetbets moderators summed it up perfectly when they posted, "That fuzzy sensation you're feeling is called respect, and it's well-earned. Wall Street no longer dismisses your presence anymore." GameStop shares are essentially still a bubble. The stock may have been undervalued to start with, but there's no way it can realistically sustain the current surge in value. The price will keep rising on a tide of investor enthusiasm until it can't rise anymore, and then the bubble will burst. But at least this time it won't be only the little guys who will pay when it does. GameStop is significant because it proves that individual retail investors do in fact have power in the market. The trend of the democratization of investing is here to stay, and the investor landscape will never be the same again. Veteran Wall Street bigwig Tiger Williams explained it best when he said, "Retail investors used to always be wrong. Not anymore. Now you've got 50 million of them all tied together and they really matter." The big boys of Wall Street will have to remember this lesson. They'll also have to be aware of contagion risk. Now that the world knows what's possible when a small group of individual investors work together, We're likely to see more of what happened with GameStop. In fact, we already have. Reddit is once again humming with activity, and the Wallstreetbets group is behind efforts to manipulate the price of shares in companies like Macy's, BlackBerry, and AMC, a struggling theater chain that's been hit hard by the pandemic. After the hashtag #SaveAMC trended on Twitter, stocks surged 200%. We definitely haven't seen the end of these types of campaigns. The situation also exposed some major flaws in our current trading systems. For one thing, the flurry of unusual activity around GameStop triggered halts on trading across many platforms. These automatic halts are designed to protect against volatility or uncertainty, which scares investors and is bad for the market. But now platforms are facing backlash for locking out small investors and being accused of effectively protecting the big boys. Online platform Robinhood, a longtime favorite of independent investors with the ironic motto of "Let the people trade," is now facing multiple lawsuits for limiting trading on GameStop. The Securities and Exchange Commission and the White House are both closely monitoring the situation, and the SEC is promising to take steps to prevent market manipulation. But at this point, it's unclear whether they're talking about the short sellers betting against the market or the Redditors who banded together to thwart them. Did GameStop break the stock market? Well, it may not be broken, but it certainly won't ever be the same. Reddit is changing Wall Street just like Facebook changed elections. And thanks to the democratization of investing, the power of everyday investors is only going to increase and continue to change Wall Street in the years to come. If you thought this video was fascinating, be sure and check out our other videos like this one called "What if the stock market crashed tomorrow?" Or perhaps you'd like this other one instead. As always, thanks for watching, and don't forget to like, share, and subscribe. See you next time.